Hi everybody, this is Ellman, the blue-collar investor. You know, one of the decisions we blue-collar investors have to make when selling covered call options is which strike price to select. We have basically three choices. We have the out-of-the-money strike price, which historically has been the most popular one, and that would be, let's say we bought a stock for $22.50 and sold the $25 strike price. Now, with out-of-the-money strikes, you have the return on your option, or ROO, R-O-O as I call it in my system, plus the possibility of making additional profit on the sale of the stock if the stock goes from $22.50 up to $25 or beyond. The second choice is the at-the-money strike price. Here, if you bought the stock for $22.50 and sold the $22.50 call, that's the at-the-money. Now, the advantage of this particular strike price is that normally you get the highest return on your option. However, you have no possibility of upside appreciation, nor do you have any downside protection. So if your stock goes up, you make no additional monies. If your stock goes down, you actually start to lose money and eat away at that profit. The third choice is the in-the-money strike. So if you purchased that same stock for $22.50 and sold the $20 call, that's an in-the-money strike price. Here you also get your return on the option, and you also have downside protection, or an insurance policy as I call it. So if your stock was at $22.50 and you sold the $20 call, you have downside protection of $2.50. But to make more sense of this, let me actually put some numbers to these and some calculations. They're all hypothetical. And I have put them up on my computer screen, so I'm going to reference them and look away from the camera from time to time. But you'll be able to get an idea as to what I mean. You may want to grab a pen and paper, jot these numbers down, and once again, these are just hypotheticals. Okay, so in the first example, in all these, we purchased the shares for $22.50. So first we're going to sell the out-of-the-money strike price, the $25 call. And let's say this out-of-the-money strike generates a return of 65 cents, or $65 for the 100 shares. Now, we calculate our option return by taking 65 and dividing it by our cost basis of $2,250. That's 100 shares at $22.50. That comes to a 2.9% one-month return. Remember, we basically sell just one-month options, and that annualizes to a very nice 35% return. Now, should those shares appreciate in value from $22.50 past $25, we're going to generate an additional $250 per contract because we've made an additional $250 per share on the 100 shares. This is represented by an 11% additional one-month return. So you can see when you sell the out-of-the-money strike, you get your return on the option, plus you have the possibility of getting additional profits from share appreciation, and that's why this out-of-the-money strike is the most popular of the three choices. Now next, if we again purchased our shares for $22.50 and sold the $22.50 call, remember strike prices move in $2.50 increments under $25. We might get a return of, let's say, $1.35. So to calculate the return on option, we take 135 for the 100 shares, divided by our cost basis, once again, of $22.50, and that comes to a 6% one-month return, 72% annualized. Again, if the price of the stock goes up, we don't share in those profits, and if the value goes down, we start detracting from that return of 6%. The third possibility is the in-the-money strike. And here, the $22.50 we paid for the stock, we sell the $20 call. And a return on an option like this might be $3.25. Now, if the option is exercised, and there's a good chance that it will be, we will be selling our shares for $20, shares that we purchased for $22.50. So we're going to lose $250 per contract. Now, we can't say that the $3.25 is profit if we're losing $250 on the deal. We need to subtract that $250 from our option premium of $3.25. Okay, so that leaves us a return of $75 per contract. Now, what happens to that $250? We do receive it, however, we're not counting it as profit. What do we do with it? Well, in my calculations, I buy down the value of the stock. I say to myself, and I enter into my log, that I purchased those shares for 20, not 22.50. Now, this is something you shouldn't do for tax purposes. I do it just for the calculation purpose of making the best investment decision at that point in time. So here's how that would look. I would say to myself that I have a return of $75 per contract, the $325 minus the $250, and I divide that by the cost basis, which is now $20 per share, which is the bought down value of the stock, or $2,000. So 75 divided by 2,000 comes to a 1 month return of 3.8%, 40% annualized. Now, that $250 or $2.50 per share is the intrinsic value of the option premium. And that represents downside protection. That's our insurance policy. So we have $250 of downside protection. Our cost basis, our original cost basis, was $22.50. That gives us an 11% downside protection. In other words, if we sell the $20 strike price in the money call, we are guaranteed a return of 3.8% for 1 month as long as our shares do not depreciate by more than 11% during that 1 month contract period. So when making your determinations, you have to determine which gives you the best chance of success. If the market is on fire and appreciating and going up and up and up, and you have a lot of confidence it's going to continue to do so, remember we're only selling 1 month options during the course of that contract period, I'd probably opt for the out of the money strike price and get the return of 2.9% with the possibility of another 11% that month. If the market is more neutral, then I probably would go with the at the money. And I also factor in, by the way, technical analysis of that particular equity. If all the technical indicators are very favorable, I'm more likely to go out of the money. More neutral, at the money, and if it's a mixed pattern, I'll probably go in the money. And finally, an in the money strike I would utilize when market is very volatile, I'm a little concerned about it, maybe it's starting to downtrend, a lot of negative news in the economy, and then I'm more likely to go with the in the money strike. In a normal market environment, I like to do what I call laddering. It's not a term that you'll read anyplace else, but basically it just means that I'll do some of each. And in a more positive market, I'll do more out of the money strikes, and in a more negative market, I'll do more in the money strikes. So all we're doing again is we're throwing the odds more in our favor, depending on the market conditions and also the technical analysis of that particular equity. Okay, well, I hope you found this helpful. I'll be giving you more information on this on my blog journal articles, and anybody that has any questions, if you email me, I'll always return your email questions. Okay, so thanks for listening. I look forward to hearing from you and wishing you all the best in investing. This is Alan. Take care.